people are projecting a recession could hit by summer or by the end of the year. In our business, when a recession hits, it's almost like not a bad thing because interest rates drop. We need to be very focused on the interest rate because the lower the interest rate, the more debt we could get, the more properties we could buy, right?
Welcome, everybody, to Real Estate Investing for Medical Professionals. I'm your host, Nathan Loy, and today we are joined by Art Cordova. Art is a certified public accountant, has worked for Royal Caribbean Cruise Lines, AutoNation, and Homestead Miami Speedway. Over the course of his career, he's been responsible for budget and revenue forecasting, internal auditing, implementing standard operating procedures, financial reporting, and overseeing the revenue growth and expense optimization that any business requires. So we are lucky to say that Art is now the Director of Finance at Viking Capital, and we're ecstatic to have him as part of the team. So welcome, Art.
Thank you, Nathan. You make me sound really good.
Appreciate it. Absolutely. So Art, before we dive into it, I know that a lot of the conversations, especially in multifamily or real estate in general, talk about the acquisition process. They talk about capital raising. But at the end of the day, I really think that the backbone of any business, but especially for a real estate investing company, is the financials of the property. So can you tell us a little bit, about how you got into finance and accounting? Were you a math whiz in high school? I want to hear a little bit more about your story.
So I went to the University of Florida, and ironically, my goal was to be a doctor, was to be a physician, just like most of our investors are. Then I really didn't have a good time with organic chemistry my freshman year, and I kind of said, this doesn't seem like it's a lot for me. And I was really good with numbers. My roommate, which I've known since I was a young kid, was going into the CPA track, and he convinced me. And then ever since then, I've just been focused on that, and it's been really I've been really loving it. I just love the math side of it, the analytical side of it, and it's the perfect fit for me.
How did organic chemistry play into it all?
It's part of the prereqs to get into med school. So you have to take those certain prereqs if you want to get into med school. So I went into college as a sophomore. So yeah, so organic chemistry came up. My friend and I dropped it. It was horrible. So I really respect those who passed it and became doctors.
Yeah, it's kind of serendipitous that you kind of find yourself now surrounded by physicians on the finance side of things.
Exactly.
So when most investors are looking at the financials of a property, typically they're looking at a pro forma or sort of a business plan that an operator has proposed to them, but they don't really get to see behind the scenes of what the kind of day-to-day looks like. Can you explain to us sort of what your day-to-day looks like now that you're with Viking?
Well, my day-to-day, I mostly deal with Viking Corporation. So I don't deal much with the property financials until around month end. That's when I review their actual to budgets and see how they did, which is very important because the budgets are very tight and we don't have a lot of wiggle room to stray from that. But on my day-to-day, really, I have a great associate who works with me who really does a lot of the day-to-day accounting for Viking. Or in terms of booking everything that hits the bank or the day-to-day transactions, my job really is a lot of ad hoc analysis, putting out some fires, or really providing a lot of support to all the other departments to make sure that they succeed. So I like that a lot. So I don't think that was available before me, and I feel that now I'm trying to help the company be much more efficient and faster, so they could finish their projects more in time so they could jump on something else.
Yeah. I love that. Given your experience with all these, different areas that you worked in, automotive, the Royal Caribbean Cruise Line, do you feel like that helped you in terms of understanding the finances of any business that you brought to Viking?
Yeah, it's pretty amazing. When it comes to accounting, people say, oh, you don't have any, multifamily syndication background. Well, it really doesn't matter because financial statements are financial statements. Accounting is one language, and it doesn't matter if you're building a rocket or you're building a scooter or selling multifamilies. The numbers are numbers, the math is the math, and it's all the same structure. Generally accepted accounting principles makes it that way. So absolutely, yeah. I mean, starting my career off with PricewaterhouseCoopers was an incredible opportunity. They're the largest firm in the world. It's really kind of like training the Navy SEALs when you're a young kid. You pass through that and you're pretty much set to go the rest of your career. The more diversity you see in your career as an accountant, the better you become. You see different practices, you get best practices from multiple people, you have multiple different bosses and associates to help you become a better manager as well, not just an accountant. I mean, it's very important. If you're a director, you're going to be managing folks, and you want to be a good manager as well. So, yeah, absolutely.
Yeah, I did the same thing when I first started underwriting, where eventually the numbers started to tell a story where I could look at a T12 or the financials of a property or the rent roll and kind of build the story of that property without even having to look the offer memorandum or any sort of the market material, just based off of the financials.
Mm-hmm.
So one thing that I think is a little bit overlooked, or at least not really talked about, is a balance sheet and how that sort of plays into multifamily and businesses in general. Can you explain, what a balance sheet is and why it's important?
Of course. So, basically, yeah, balance sheet. Not a lot of people are familiar with the balance sheet. They're mostly familiar with the T12s and the income statements, but the balance sheet is very important. The balance sheet is basically your statement of value. What is the company worth? So it'll the balance sheet starts off with your assets. How much cash do you have? What are your fixed assets? Your capex per se. How much building do you have? How much land do you have? Um, then it'll basically go into your liabilities. What do you owe? So you basically your mortgage payments, your accounts payable, how much do you owe your vendors? Your basically what do you owe the bank in interest, things of that nature. And then basically your assets minus your liability is your equity. And the equity is what the value of your company basically typically is. So if you have a negative equity, if you have more liability than you do assets, well, guess what? You're kind of in trouble. You kind of want to reverse that. If you have $100 million mortgage, but your property's worth 60, you're in a negative position, right? So you don't want to be there. The balance sheet gives you that story.
So it's kind of like the health of a property at any given one, or not of a property, sorry, of a company at any one point in time.
Absolutely. And
Interesting.
each property is considered its own company. So every property has its own balance sheet and its own income statement.
Got it. So there's a balance sheet for each property and there's a balance sheet for a company as a whole, at least in terms of multifamily.
For Viking, there's a Viking balance sheet. Yeah. And right. Mm-hmm. And we can consolidate them all into one big balance sheet if we wanted to. Yes.
Interesting. Going back to the point that you just made, if you do happen to see a balance sheet where there are more, liabilities than there are assets, what's the typical way to turn that around? Are you cutting down on liabilities? Are you expanding the asset side of things?
Typically, it's hard to expand your asset base when your liabilities are so high. So you really want to get a good picture of what happened. I mean, typically a bank's not going to loan you more money than the value is of the property. But unfortunately, properties could diminish in value, right? We saw it in the mortgage crisis in 2009. You want to see the story. Is it you have a lot of aged accounts payable? Do you not have good cash flow in your asset side? There could be many reasons why. A good company, a solid company, should have the right outlook. You always want to do. You want to look a year ahead and make sure that you're not going to get in that position. But yeah, sometimes it just might take time to turn it around. Sometimes it just be the market value of your properties just need time to change. But hopefully you're cash heavy enough that you could support that downturn in your business and wait for it to come back up.
Right. Can you explain sort of what the difference is between a balance sheet and a profit and loss statement? Especially, in our industry, we talk about items that are above the line and items that are below the line. Can you dive into a little bit more?
Well, if you want to talk about above the line or below the line, if you look at a typical T12 for a property that's trailing 12 months, that's 12 months worth of income statements, you're going to have what you call your day-to-day operating expenses, right? You're going to have your revenue. How much are the tenants paying? There's some miscellaneous stuff that the tenants pay. You're also going to have vacancies. You're going to have some negative income, right? You don't want to have that. You want to keep that as low as possible, right? So you're going to have your income side. Then you're going to have your day-to-day operating expenses, your payroll, the kind of maintenance you do every day. Little paint jobs and appliance repairs, HVAC repairs, the kind of stuff that you can expect every day to happen, right? You have your management fees. You have to pay the management that's running the company. And utilities. That's a huge one, right? So then once you subtract those numbers, that income minus that expense, that's called your NOI. That's the heartbeat of your company. You want that number to be nice and healthy. I would say at least 60, the ratio should be at least 65%. So you get NOI, you divide it by your rental income. For me personally, other investors might think differently, but for me, 65% is at least where I'd like to see it at. If it's below that, now we're getting a little tricky. Why? Because right after that number, now we're getting below the line, which is still cash, right? You still got to disperse cash.
And
Cut your, that's your, I'm sorry,
before we dive into the below the line items, I just want to make one note. The NOI is typically how multifamily properties are valued. So you have the NOI, and you divide that by the cap rate, which is essentially what assets are selling for in that market, and that's typically how you get the price for any specific multifamily apartment.
Right. And that's why it's so important that NOI is healthy, right?
Right.
Because if your income is, $100,000, but your expenses are $90,000, now you have $10,000 of NOI. You can't maintain the company because now you're going to have all these below the line items you got to take care of.
Right.
Below the line means these are not things that are typically attributable to the property. So the first thing and one of the most expensive thing is debt service. That's how much interest you pay the bank every month. And that's typically a hefty number. So your NOI typically should be about 125% of what your debt is. So if you divide your NOI by your debt, it should be about a 1.25 ratio. That's pretty healthy. If it's below that, if it's below 1, now guess what? Now you have negative NOI after debt. So if you have negative NOI after debt, well, now you get to the next level, which is your asset management fees. That's what you owe the owner. So the owner gets his cut after every month. That could range differently from 2% of income to 1% of equity raised. There's multiple ways to get that number, but that could, that's about 20 grand a month sometimes. And then you go below to your unusual repairs. So a lightning bolt hits your a tree on the property, or most recently we had a couple of properties that had frozen pipes. There was a big winter storm that came through and froze the pipes. That's not common, right? Sometimes you can get that reimbursed by insurance, but then you got to decide if that's worth it or not. So those are unusual repair items. And then you have items that go to the balance sheet. Also, they're CapEx. So these are, I want to replace the roof, or I'm going to replace all the HVACs across the property. Typically on this line of business, you raise that money as part of the capital, as part of the raise of the property. So you forecast that, you raise it, and you have that as a cushion. So you're okay there, but your NOI has to be strong in order to support that debt service, asset management fees, and then those unusual repairs. Because you don't really raise that money. You could raise a reserve. You could put your finger in the wind and see, okay, $200,000, but maybe these pipes burst. It could be $300,000. You never know,
right?
So you really want to have that healthy balance of income to expense, and so that NOI could cover your day-to-day process.
Yep. And also a good way to think about it is everything above the line is somewhat property specific. Everything below the line is typically owner specific. So that's why these multifamily assets are valued based off of NOI, based off of the actual operations on the property, because the debt, the CapEx that you mentioned, that could vary from owner to owner.
Right.
And, a lot of people, when they think about, accounting, there's two different types of accounting. There's cash basis and there's accrual basis. Can you explain what the difference is between the two, and then kind of the pros and cons of using one over the other?
Okay. I'll start off by saying that cash-based accounting is kind of, I want to say old school, but it is where basically it's the easiest form of accounting, because all you do is just post numbers when it hits your bank. Your bank and your income statement's going to look identical at the end of the month. It's not my favorite way of doing things. It's more of a tax basis for some entities, and it's good for smaller entities that, for example, if you are a maintenance worker and you go to a job, you spend all your money there, you got to go to Home Depot, you got to buy your parts, and then the client pays you that day before you leave, well, that's perfect. That's cash basis because everything happened at the same time, right?
Right.
So that's more simplistic. But a larger company, now you get into the accrual accounting side where you want the month to reflect what actually happened in that month, even if you didn't receive the cash. So, in other words, let's say payroll. So the last 2 weeks, so the 15th to the 30th, the payroll, the employees worked, but you don't pay them till the following week, which is in the following month. Well, where do you want that expense to hit your T12? You want that expense to hit in the month that it occurred, in the month you actually did the work. So you're going to book what's called an accrual. You're going to hit the expense, and and on the balance sheet, you're going to have an item called accrued expenses. You're going to reverse that entry at the beginning of the following month, and then when you pay it, it zeroes out in the expense side. So when you look at your books, when you look at your income statement, that's the true identity of what happened in that month. So if you sold something, if you sold 5,000 widgets, and the client doesn't have to pay you until they receive it, well, guess what? You sold it. So you put that money. So in January, I sold 5,000 widgets, even though they're going to pay me in February. So I book an accounts receivable. And accounts receivable is that. Your accounts payable is the same thing. So accounts payable, you get the utility bill, utility bills for the 1st to the 30th. So when you're going to pay it the following month, right? But you want that expense to hit in the month that it occurred. So the accrual method gives you an accurate picture of what's happening to your company on a month-to-month basis.
Got it.
Cash just gives you where your cash flow is coming in and out. So unless it's a situation like I mentioned to you that all the cash and the transactions happen on the same day, it's really not a very useful method of doing accounting.
Right. What happens if, you do the accrual method, you send something to, accounts payable or accounts receivable, but that money doesn't come in or that money doesn't go out? What happens then?
Well, that's not good. Obviously, so accounts receivable and payables, you really want to keep a good track of it. You really want to keep a good track of it. You want your receivables to be no more than 60 days old. You want to, after that, you want to call your customers and find out where they're not paying. Typically, you'll set that standards with your customers. They're going to pay you within 45 days of receiving the invoice. Whatever you negotiate with your clients. Payables, you also want to make sure you're not more than 30 days old from the due date. So, those vendors are expecting their money within a certain amount of time. You want to make sure your company's healthy enough, because if you don't, then guess what? You're going to lose your vendors. Or a vendor can even put a lien on your business if you don't pay them in time. So you want to make sure your cash flow, again, your NOI is strong. You're keeping a good handle on all of that, so you can pay your vendors on time, and hopefully you have good customers that pay you on time as well.
Right. So it seems like a cash basis is a little bit more rudimentary, where you're only counting cash in and cash out. Accrual method can be more beneficial as long as you have those systems and that proper communication in place with all your other parties that you're interacting with.
Absolutely. Exactly.
Got it. Okay. While we're on the topic of cash and how to count it, what is a cash projection? What does it portray? And again, why is that important? And how is it different than, the balance sheet or the P&L that we were just talking about?
Well, the most important phrase you'll ever hear in accounting is cash is king, right? So cash runs your livelihood. So you really always want to forecast where you're sitting with cash. So let's say, very rudimentary, you start with your beginning cash. How much money is sitting in your bank account? How much are you going to spend? So how much income is coming in for that month? How much expenses are going to go out for that month? That's kind of your NOI, right? What we already talked about. And then what other CapExes are going to go out? And what other maybe miscellaneous things are going to happen? And where's your cash at the end? Are we positive? And then try to roll that forward every single month. Because it should be, especially in this industry that we're in, it's pretty straightforward. As long as you have, the biggest difference would be if you have a very sharp decline in your vacancy. If you keep your vacancy at 90, 95%, kind of how much cash is coming in every single month. What your expenses are pretty much every single month. Payroll's the same, utilities the same, maintenance is pretty much the same. So it's very easy to track that way. And you want to make sure you have that gap of extra cash if you have to make basically, things that don't happen on a daily basis, things that don't happen on a monthly basis. You want to make sure you have enough money for your distributions to your investors as well. You want to keep them happy. So you're just kind of just forecasting what your bank balance is going to be every single month after you close the month out.
Got it. So it's kind of like a pro forma, but on the company basis where you're projecting future cash and future expenses to essentially find that bottom line, that NOI or the revenue that's going to come in for each property as well as a company.
Exactly. Mm-hmm. You kind of do that. You align that with your budget every year. So when you make your budget, you're pretty much making your cash flow forecast for this at the same time every single year.
Got it. And that's especially helpful, in our business because we are in the value add space where there might be, increased income while we're doing the value add plan. We're renovating units. We're, placing premiums on top of that. So my assumption is that you work pretty closely with the asset management team. But how do your roles kind of differ from the asset management side of things and what you do?
Well, the asset management team they're very, very responsible for the physical aspects of the property. I mean, they're looking at, CapEx projects. What are we going to fix when it's broken? What is our vacancy? Who do we have to, as tenants leave, we got to bring new tenants in, making sure everything is working on the property, right? And then at the end of the month, the property managers give us the financial statements, and we got to review that and compare that to what the initial budget is, and also what our initial pro forma was. We want to make sure that our pro formas were accurate, right?
Right.
And see if there's any big diversions. So, one thing that happens is, interest rates shoot up on, we hit a bucket of inflation. Interest rate has gone up. That's not in the pro forma sometimes. That's not in the original budget. So now you're like, oh, well, this expense went high. Now, okay, property, well, how are we going to fix this?
Right.
You can't just identify the problem. You got to come up with a solution. Does that mean we have to raise rents? Does that mean we have to cut expenses? Where are we going to find that extra cash that we never anticipated?
Does that mean that you are continuously tweaking that cash projection? It's not something that's stagnant that, at the beginning.
No, you have to. No,
Yeah.
Absolutely. Every month you start fresh, right? I mean, you do your cash flow forecast. So January 1st, your bank balance is $100,000. Whatever you end up January 31st, that's your new number. That's your new beginning number. So you want to compare that to what you were forecasting, but now you have a brand new number. So you constantly, that cash flow forecast keeps rolling.
I love that being proactive. And it's a little bit easier to do on our end because we are in that value add space where we're picking up properties that already have a history of financials. You can already somewhat tell, how the property has been run in the past few years based off of the T12 that shows you, the marketing expense, the admin expense, the repairs. The same is not necessarily true for new construction deals because there isn't any sort of, trailing data that you can base it off of. You might be able to pull expenses that are common in the area, but it's a little bit more difficult to do a cash projection on a new construction where you don't exactly know the revenue or the expenses that are going to come in, right?
Exactly.
So if an investor is reviewing, the pro forma or financial property, whether that be new construction or value add, are there any sort of red flags they should take note of or things that, they should really pay attention to?
Oh, like I mentioned before, two really big ones. Or you want to look at that NOI. You want us to make sure that NOI is healthy. If you see an NOI that's in the 40% range, low 50s and below that, you want to say, okay, well, now you're a little scared. You want to see what the rest of the numbers are below that. Now you look at your debt service. Do you have enough NOI to cover your debt? Are we looking at that 1.25 ratio or are we below 1? Because if we're below 1, then we might have negative income after debt. You might have negative cash flow after debt.
Right. That's a good point.
Now you don't have enough money to cover all the unusual stuff that could happen on your property. Now you're basically running dirt poor. And that's not something you really want to be focused on. So then you want to so if you see that, you want to take a look back up to the income side. Are they running at like 80% vacancy? Or are they at 95% vacancy? And so quite honestly, if you're running a 95% vacancy and you're still low on your NOI, that property is not being run very well.
You mean occupancy, right? I mean, because
occupancy, 95% occupancy.
If you're 95% vacancy, you might feel like a new construction.
No, the opposite. So 5% vacancy and your NOI is low, and something's wrong with the management of that property, or we're not charging enough rent, or something's happening there. So there's a story right there in those three lines. When you look at your income, your expenses, your NOI, your debt service, there's a good little story very quickly you could say about the property right there.
Yep. And it's the
So
same
those
true
are,
on the acquisition side of things too. And we're looking at T12s. We can start to tell a story where if we start to see, for example, vacancy increasing, right? So occupancy is dropping from, call it 90% to 85%. You may see, concessions increase where, the current owner is offering 1 month free, 2 month free to get new tenants in the door. But what's funny is that everything is interrelated. So if vacancy increases, for example, your turn cost or the cost it takes to turn an apartment might increase, or the bad debt on the property may affect the vacancy. They're all tied together. So it's really interesting. When you're looking at the financial well-being of a property, what are the main things that you look for to say, hey, this is, a healthy story? Because all the numbers tell some sort of story.
well, first thing I'll do is look at the balance sheet, make sure like our assets are what's our equity? Are we doing much better on the asset side than the liability side? Do we have it all cash flow in the bank? You want to do your cash flow projection. You want to see the budget of the portfolio. You want to see how that cash flow is going to work out for the rest of the year. When we're said and done with everything, did we cover all of those, all those numbers below the line that we had to cover? Were we able to give distributions out to our investors? And were we able to maintain a very healthy occupancy rate, maintain that healthy NOI, cover our debt service without a problem, 1.25 ratio or above? And we do all that. It sounds easy, but you look at all that in the picture, you have a healthy property.
Yep. I love that. And I love how much you're pinpointing debt, Art, because the banks are the largest investors in the deal. People often think it's, the investor equity, but the banks are putting up a large part of capital, and they have certain tests to make sure, debt yield test or that DSCR, that 1.25 ratio that you were talking about. They have these tests in place to make sure that, the health of the property can sustain that the risk that they're doing by, placing their equity with us as sponsors as well.
Exactly.
So pivoting more towards, the CPA side of things, because I know that's a little bit more of your background. If an investor is looking for, CPA, what are some real signs of a strength of a good CPA?
It depends what you're looking for. I mean, I'm specialized more in the financial side. I come in and look at the analytics. I look at the health of a company. Then there's the tax folks. So tax, usually a financial CPA like myself doesn't understands the tax side, but not as strong as a true tax CPA. So Viking Capital, we use a separate CPA to do all of our K1s for all of our investors and all of our tax returns for all of our properties. I help that process along, and I provide all the information to that CPA, but I don't necessarily do the work. So it depends what you're looking for. I mean, you got to look at their background, got to look at their experience, and look at their reviews, like you would any other position. Like if you're looking for a good doctor, hopefully they have good reviews and good recommendations, word of mouth, that sort of thing.
Got it. That's really interesting because it seems like then there's two different sides to the CPA realm. There's CPAs for companies in terms of the financial stability and the financial well-being, and there's CPAs to help out sort of more customer facing, where they're talking about taxes and K1s and more sort of bonus depreciation, those sort of tax benefit that side of things.
Exactly.
Interesting. So with that, if you find a good CPA, is it required or is it suggested that they know real estate if you are doing a lot of real estate transactions, or can you find any CPA out there and the process will be similar?
Honestly, I would like to find someone who knows the industry that I'm in. If we're talking about taxes and K1s, that's not a very easy process. I mean, when you're talking about bonus depreciation, there's different laws. Every industry has its own tax loopholes. I don't know if that's the right word to use, but it does. So you want your tax accountant to know you want that specialty. You can walk into those big firms and you grab something. You grab your next in line, like an H&R Block or something like that. they might not know your industry very well. So when you're in this business, you have a big group of investors. You want to chat with them and say, who are you using? Or we should make recommendations. People that specialize in that industry. Yeah. So no, I would not. Typically, like a doctor, you're not going to go to a cardiologist if you have a bad ankle. So, or vice versa. So
Right.
that's the way I see it. Yeah.
Right. Yeah. Especially is super important. Super important. So when talking about, CPAs and finances, I always like to touch on being proactive rather than reactive, especially when it comes to CPA. If you're going to them for advice, or if you're looking at, budgeting on the property side of things, what do you do to sort of be proactive with Viking?
Well, Viking, it's you got to learn. You got to learn the industry. First of all, you got to understand all the ins and out of the industry. You want to look at the history of the properties. If it's a brand new property, that's a little more difficult, right? But you want to be proactive. You want to reflect in your future cash flows things that can be unexpected. You want to say, hindsight's 2020, but when the interest rates were running at 3%, we could have done a sensitivity study where we said, well, what happens if the interest rates jump to 8%, 9%, which is what happened, right? And then can we survive that if it does happen? And if we can, do we roll the dice and take the property and buy the property, or do you not? So you do want to be able to say, you do want to come into a worst case scenario position where if your occupancy drops to 80%, what's your break even point? Where is the point where you can sustain that 1.25 debt ratio before you go into negative debt? And now you're going to tell your investors, look, I'm sorry, I can't do any distributions this month.
Yeah.
You want to foresee that. You want to be proactive in that. So the owners are aware, and the asset managers are aware. Because if you start seeing that trend coming, you better start preparing.
Yeah.
When that hurricane's coming and it's 2 weeks away, you got to start bordering up your home. So definitely you want to be in that position. A good CPA will put you in that position versus everything's gonna be bright and beautiful. It's going to be consistent for the next 12 months, and here's a beautiful budget. Then you blow it, and then that's not good.
Right. Hope for the best, but prepare for the worst. Right.
Absolutely.
I love that you're talking on or touching on the break-even occupancy too, because that's a really good way of, just high level testing the strength of the property. Is can they meet all the expenses that they're projecting, and can they meet all the debt service? Because those are really the two major risks, especially in real estate, is meeting those two. And then you can talk about, distributions and CapEx, but primarily if you're not meeting your expenses or your debt service, that's really where you get in sort of a sticky situation.
Exactly. Mm-hmm.
And we just talked with Roger on one of the latest episodes about how to beat the market 80% of the time. And sometimes it's about risk mitigation more so than it is, about excelling revenue and going sort of above and beyond. Because what he was saying was there's always going to be, these lagging indicators, but the real strength and power is being able to assess the current times and then what's coming, in the future that's eventually going to, cross your path sooner rather than later, right? Mm-hmm. So, especially during times of COVID, where I don't think anybody could really have predicted where things are going with the interest rate hikes and how high the Fed was going to increase their Fed's fund rate, what was going to happen to bridge debt properties. So COVID was a little bit of a strange time. Do you see things going back to quote unquote normal operations in the near future? Or are you sort of always, looking into the future for potential sort of one-off events that could impact the financials of a property and of the company?
Well, right now, I mean, we're in the middle of a time where it's a little testy. We don't know when we're going to hit a recession. The recessions could be, people are projecting a recession could hit by summer or by the end of the year. I was talking to one of my associates where in our business, when a recession hits, it's almost like not a bad thing because interest rates drop. And our business and our line of business, we're very interest rate. We need to be very focused on the interest rate because the lower the interest rate, the more debt we could get, the more properties we could buy, right? So right now, because of the inflation, interest rates are going this way. Once inflation plateaus and it starts dropping and it hits more of the Fed fund rate of like around 4%, then interest rates are going to start. Then that's kind of when the recession hits. And because now nobody's buying anything anymore. So now the market went backwards really fast. The goal of the Fed is to raise interest rates at a level where spending decreases slowly. But sometimes if you raise it too fast, you shake the market up so quickly that a recession could occur. And then to get out of the recession, you got to drop interest rates rapidly. So, and then that's where folks like us in the multifamily syndication world take huge advantage of that situation where now we can go to banks and say, we want to buy. Where others are kind of being conservative, we're being more aggressive. So
Right.
we got to take a look at that every year. So you constantly want to have your pulse of the economy. You constantly want to see what's happening. And there's so many resources out there. I mean, I love using the Wall Street Journal. That keeps you on the pulse of what's going on.
Right. I love that. Because at the end of the day, real estate is cyclical. So if you can really understand at a high level, the demand and supply imbalance that kind of drives pricing, that drives interest rates and rate caps and all these things go into sort of the financials of a property. That's really, as you said, Art, where you can be advantageous and really sort of leverage the market where others, if they're too focused on the day-to-day and they don't really see what's coming further down the line, or they don't have the time to really take a step back and work on the business, it presents an opportunity for those that really do understand the more macroeconomics of the cycles that are to come.
Absolutely.
What other sources outside of the Wall Street Journal are you using to keep tabs on or keep a pulse on the economy?
I like going to CNBC. CNBC is a very good. CNBC is good as well. Quite honestly, and I also like to keep track of the politics going on because those could change things very rapidly. Foreign relations. The war in Ukraine, things of that nature. So you don't want to just stick to financial literature. You want to just take a look at basically cable news or your normal news every day and see what's happening. Wall Street Journal kind of gives you that big picture. You see all of it. So that's why I like it the most. It's very fair and balanced, in my opinion. So those are the ones I typically try to focus on. And look at the regular US.gov or the IRS website, see what's going on with the Fed rate, the projections of where the Fed rate's going to be at, where people are projecting the inflation rate to go down to. It's very important as well. So
yeah. I love that. I love that you're taking like a multifaceted approach where you're not just looking at just financial resources and you're really kind of expanding out into politics, population, migration. Because that's really at the end of the day what drives that demand in any given area, right? Because a property can be stellar, but if a government ordinance comes in and can caps rents, for example, right, rent control, which you typically see in a lot of tenant friendly states, is great for the tenants, but can actually impact your business plan. Where going back to the accrual based accounting that we were talking about, where if you're projecting increases, especially while you're doing your value add plan and putting premiums on top of loss to lease recapture, but you're capped at how much you can increase those rents on renewals or new leases, it again, you can get yourself in a really sticky situation.
Well said. Exactly.
Mm-hmm. Awesome. Well, this has been great, Art. I really enjoyed the conversation. It's not oftentimes that you get to sort of nerd out on the finances and stuff, so I love it. If our audience wants to get a hold of you and learn more, how can you get a hold of you?
You can email me at Cordova@VikingCapLLC.com. And I'll be happy to answer any questions for you.
Awesome. Thanks, Art. Really appreciate it.
Thank you, Nathan. Have a great day.